It is early 2026. In a single trading session, nearly $589 billion in U.S. market value evaporates. No war, no sanctions shock, no rate emergency. The trigger is a chip priced at $5 that does something the system insisted was impossible. That insistence was the tell. For years, U.S. technology valuations rested on a story. Advanced AI required extreme capital, rare expertise, and protected supply chains. Costs justified dominance, dominance justified margins, margins justified valuations. The entire structure depended on one assumption, that the physical layer could not be commoditized. The $5 chip breaks that assumption. It does not outperform flagship hardware on every metric. It does not need to. It collapses the price floor. And once the price floor collapses, monopoly pricing collapses with it. What markets were priced in a day took years to build because the value was never in silicon alone. It was in control. This is how empires lose leverage. The reaction is framed as a market overreaction. Analysts call it sentiment. Commentators blame positioning. None of that explains the scale. Hundreds of billions do not vanish because of mood. They vanish because a premise failed. That premise was scarcity. For a decade, U.S. tech traded as if production were optional and margins were permanent. Capital flowed into software layers, stacked on hardware assumptions no longer anchored to cost. Financial claims multiplied faster than physical output. Valuations became paper abstractions defended by narrative. The $5 chip punctures the narrative. It proves that computers can be produced cheaply, at scale, outside the financialized ecosystem that priced it as rare. It proves that manufacturing catch-up neutralizes pricing power faster than regulation ever could. And it proves that the system mistook capital intensity for permanence. This is not a technology story. It is a settlement story. When physical capability becomes widely available, paper claims reprice violently. The market does not ask whether margins will compress. It assumes they must. And when margins are the only thing supporting valuation, the reprice is immediate. The loss is not innovation-driven destruction. It is recognition. Recognition that the mechanism has shifted. For years, valuations were protected by choke points, fabs, export controls, proprietary stacks. Those choke points created artificial scarcity. Scarcity sustained price. Price sustained leverage. Leverage sustained paper wealth. The $5 chip routes around the choke points. Once routing exists, replication follows. Once replication follows, monopoly dies. And when monopoly dies inside a debt-saturated system, repricing is not gradual. It is violent. This is stage 4 behavior. Paper value collapses not because demand disappears, but because control does. The market does not wait for earnings to fall. It reprices the future the moment scarcity is disproven. The $589 billion loss is not a market event. It is the first visible fracture in a system built on financialized technology, where valuation ran ahead of physical reality. And once physical reality reasserts itself, the unwind does not stop at one chip. The thesis: why monopolies always break. Monopolies do not collapse because competitors announce themselves. They collapse because cost reality catches up to narrative control. Every monopoly survives on the same condition: the belief that alternatives are impossible, uneconomic, or unreachable. The moment that belief breaks, pricing power dies. This follows a fixed historical cycle. Stage 1 is scarcity and control. A critical input is difficult to produce. Capital requirements are high. Expertise is rare. Supply chains are narrow. Control is enforced not just by ownership, but by the perception that replication is unrealistic. Prices reflect power, not cost. Early dominance feels permanent. Stage 2 is financial expansion. Once control is accepted, financialization begins. Margins are treated as structural. Valuations detach from production cost and anchor to future expectations. Debt and leverage expand against those expectations. Paper claims multiply faster than physical output. The system assumes scarcity will hold indefinitely. Stage 3 is cost convergence. Physical reality re-enters the equation. Manufacturing techniques spread. Processes improve. Inputs standardize. What once required elite infrastructure becomes reproducible. This stage is ignored because it develops quietly. The monopoly remains profitable, so risk is dismissed. Stage 4 is price collapse and reset. A single event exposes the new cost floor. It does not need to outperform the incumbent. It only needs to exist. Once an alternative proves functional at radically lower cost, pricing power evaporates instantly. Markets do not debate. They reprice. This is where the system stands now. The $5 AI chip does not threaten dominance by being superior. It threatens dominance by being sufficient. Sufficiency is lethal to monopolies built on margin expansion. Once customers can meet needs without premium pricing, future cash flows compress. When cash flows compress inside a leveraged system, valuations collapse. This is not about competition. It is about debasing scarcity. Financial markets assumed technological control could not be replicated without matching capital intensity. That assumption was wrong, and when assumptions fail at scale, the unwind is not linear. Debt magnifies repricing. Expectations amplify loss. Confidence disappears faster than it formed. This is why the reaction is so large. The monopoly was not broken by regulation or policy. It was broken by arithmetic. Once production cost collapses, no narrative can restore pricing power. Once pricing power dies, paper valuations must follow. This is the mechanism. And once it activates, reversal is mathematically impossible. Historical proof. The rule of three. The collapse triggered by the $5 AI chip is not a modern anomaly. It is the same mechanism repeating under new material conditions. History records this pattern with enough precision that denial becomes the only remaining explanation for surprise. Three cases, Rome, Weimar Germany, and the post-1971 monetary order, prove how dominance fails when cost reality overtakes paper control. Rome is the first proof. Rome's early power rested on monetary credibility and material dominance. The silver denarius contained real metal of consistent weight. Soldiers accepted it for pay, merchants accepted it for trade, the state accepted it for taxes. Rome's economy expanded because money enforced discipline. Power flowed from control of land, metal, and labor, not from abstraction. Expansion changed the equation. Legions multiplied, borders stretched, infrastructure hardened, political loyalty became expensive, taxation reached its ceiling. Rome faced the same choice every empire eventually faces: constrain ambition or alter the measuring system. Rome altered the measuring system. Under Emperor Nero, the silver content of the denarius was reduced. The coin's appearance stayed the same. Its legal value was enforced. The change was framed as technical necessity. This was the moment dominance detached from physical reality. Debasement accelerated across successive emperors. Each reduction funded short-term stability at the cost of long-term trust. By the 3rd century, Rome introduced the Antoninianus, officially worth 2 denarii, but containing far less than double the silver. This was not innovation. It was an admission that control over cost had been lost. Prices adjusted immediately. Soldiers demanded more coins for the same service. Merchants raised prices defensively. Long-term contracts vanished. Savings lost function. Rome responded with enforcement rather than restoration. Value did not disappear. It concentrated. Those who controlled land, grain, and state contracts preserved power. Those paid in currency absorbed loss. Rome did not collapse because of invasion first. It collapsed internally when money no longer measured reality. The empire maintained legal authority long after economic dominance was gone. This is the first rule. When cost reality reasserts itself, paper control fails before political control does. Weimar Germany is the second proof. In 1923, Germany faced reparations totaling 132 billion gold marks. These were not abstract claims. They represented fixed metal weight. Germany did not possess the capacity to pay. The obligation was mathematically impossible to settle honestly. The state chose printing. Initially, the response looked successful. Industrial output appeared to recover. Employment stabilized briefly. Equity prices surged. On paper, wealth exploded. This was not recovery. It was the monetary unit collapsing faster than prices could adjust. As printing accelerated, velocity followed. Holding currency became irrational. Prices rose not because of speculation, but because the measuring unit failed. Bread moved from 160 marks to billions, then hundreds of billions. Savings were annihilated. Fixed incomes evaporated. Again, value did not vanish. It moved. Those with access to credit and assets converted marks into factories, equipment, land, and inventory. Exporters held foreign currency. Insiders settled obligations with depreciating paper. Wage earners and savers were erased. The public misread the signal. Rising asset prices looked like opportunity. In reality, they marked the final extraction phase. By the time recognition arrived, the transfer was complete. Weimar demonstrates the second rule. When the unit of account collapses, assets reprice violently upward while purchasing power collapses downward. The chart did not warn, it was confirmed. The United States and Britain after 1971 formed the third proof. After World War II, Bretton Woods anchored global currencies to the US dollar and the dollar to gold. This imposed discipline. Claims could not expand infinitely because settlement required metal. That restraint ended in 1971. On August 15, 1971, President Nixon closed the gold window. Bretton Woods ended. The final physical constraint was removed. The dollar became pure credit. This created the exorbitant privilege, the ability to issue global claims without immediate settlement. What followed was not balanced growth. It was financial dominance detached from physical production. Debt expanded faster than output. Financial markets grew larger than the real economy. Asset prices rose faster than wages. Saving in currency became punishment. Speculation replaced productivity. The system rewarded leverage and narrative rather than efficiency and cost control. This was debasement in structural form. Over decades, capital flowed toward protected sectors, equities, real estate, financial instruments, while manufacturing hollowed out. Physical production was offshored. Cost discipline was replaced by margin expansion and financial engineering. Dominance appeared absolute because paper claims multiplied without friction. That illusion held only while alternatives were constrained. The $5 AI chip exposes the same fracture point. For decades, U.S. tech dominance assumed hardware scarcity would persist. Capital intensity was mistaken for permanence. Financial claims expanded on the belief that production could not be replicated cheaply. That belief failed. Across all three cases, the same sequence appears with no deviation. First, dominance is enforced through physical control. Second, abstraction replaces constraint. Third, paper claims outgrow material capacity. Fourth, cost reality reasserts itself. Finally, paper dominance collapses while physical capability regains leverage. This is the rule of three. Rome lost control when metal content collapsed. Weimar lost control when currency collapsed. The modern system loses control when cost collapses monopoly pricing. Timing explains why reactions always seem sudden. Elites recognize cost convergence early because they watch margins, supply chains, and settlement risk. The public recognizes it late because losses appear as valuation shifts rather than confiscation. The $589 billion loss was not about one chip. It was the recognition that dominance was priced on assumptions no longer true. Once those assumptions fail, debt magnifies repricing. Confidence evaporates faster than it formed. This is not technological disruption. It is structural correction. When physical production catches up to financial abstraction, paper value must yield. History does not negotiate this outcome. It enforces it. The mechanism has already been activated. What follows is not recovery. It is reordering. The modern trap. Financialized technology. Single continuous section. Target 650 words. You will verify and trim if needed. The real damage caused by the $5 AI chip is not limited to one market sell-off. It exposes the modern trap that has defined U.S. technological dominance for 2 decades. Technology was no longer valued as productive capacity, but as a financial instrument. This distinction matters. U.S. tech firms did not just sell products, they sold expectations. Margins were treated as permanent. Market share was treated as destiny. Valuations were built not on cost efficiency, but on the belief that competitors could not reproduce the underlying hardware without matching capital intensity. That belief became the foundation of trillions in paper wealth. This is the trap of financialized technology. Once dominance is financialized, survival depends on maintaining narrative control rather than improving physical efficiency. Research budgets grow, but cost discipline disappears. Supply chains become fragile. Production is optimized for shareholder optics, not resilience. The system becomes profitable but brittle. China's $5 chip is not impressive because of its performance. It is devastating because of its economics. It demonstrates that functional compute can be produced outside the premium pricing ecosystem. That single fact collapses the logic sustaining valuation. Financial markets respond instantly because they understand one thing. Margins are not defended by innovation alone. They are defended by barriers. When barriers fall, cash flows must be rewritten. This is where debt becomes lethal. U.S. tech dominance was leveraged. Future earnings were pulled forward through buybacks, stock-based compensation, and cheap credit. Balance sheets were engineered to reward rising valuations, not falling margins. When cost pressure appears, leverage accelerates loss. This is why $589 billion vanished so quickly. The system was not repricing one company, it was repricing a structure. Once one node proves replicable, the assumption of scarcity collapses everywhere. The market does not wait for earnings revisions. It prices the end of control. This is stage 4 behavior. In earlier stages, financialization amplifies dominance. In stage 4, it accelerates collapse. The same leverage that inflated valuations now multiplies downside. Confidence does not unwind gradually because it was never grounded in physical reality. The geopolitical layer deepens the trap. For years, export controls, sanctions, and choke points were treated as permanent defenses. They were not. They were accelerants. They forced alternatives into existence. They subsidized replication. They compressed timelines. Physical production always catches up when incentives are aligned. Once it does, financialized dominance has nowhere to retreat. It cannot cut costs fast enough. It cannot reprice gently. It cannot restore scarcity without abandoning scale. The structure collapses inward. The public experiences this as market volatility. The insiders experience it as loss of control. This is why the narrative shifts immediately. Analysts stop talking about growth and start talking about resilience. Guidance becomes vague. Long-term visions replace concrete forecasts. This is not confusion, it is retreat. The modern trap is believing that technology dominance is secured by capital alone. Capital can inflate, capital can delay. Capital cannot defeat cost convergence indefinitely. When physical capability becomes cheap, paper valuations must compress. No policy can prevent this without openly abandoning markets themselves. This is not about China versus the United States. It is about physical production versus financial abstraction. One always wins. History has never recorded a counterexample. The $5 chip did not destroy wealth. It exposed that much of it never existed outside spreadsheets. Once that exposure occurs, the reordering is irreversible. The mechanism does not pause, it advances. When paper meets hardware. What follows this moment is not recovery, it is repricing. The $589 billion erased by a $5 chip was not destroyed by competition. It was destroyed by reality intruding into a system built on abstraction. Financialized technology assumes margins are permanent, scarcity is enforceable, and dominance can be maintained through capital alone. Hardware disproves all three. This is the final stage of the cycle. Paper claims expand until they encounter a physical constraint they cannot override. When that happens, valuations do not adjust politely. They collapse to meet cost. This is paper versus physical resolving in real time. The system will attempt to reframe this as volatility, sentiment, or transition. Those words exist to mask the truth. Once monopoly pricing is gone, exorbitant privilege evaporates. Once privilege evaporates, leverage becomes fatal. Once leverage becomes fatal, the reset is unavoidable. No regulation can restore lost scarcity. No subsidy can resurrect collapsed margins. No narrative can reverse cost convergence. This is why the reaction was immediate and severe. Markets understood that the future cash flows were fictional. The chip did not need to win benchmarks. It only needed to exist. History always ends this way. Rome lost control when metal content collapsed. Weimar lost control when currency collapsed. The modern system loses control when cost collapses financialized dominance. The mechanism does not negotiate. It resolves. Subscribe to Epic Atlas to understand how these structures are built, how debasement operates, and why every paper empire ultimately yields to physical reality. This is not disruption. It is inevitable.